to no need to be too formal about it. Okay, so why don't we go to the first slide? Well, what is transfer pricing? Transfer pricing refers to the need for multinational business groups in all industries to ensure that transactions among group members, who are usually called related parties, are conducted on an arm's length basis. And the arm's length is an important buzzword in the transfer pricing field, in order to avoid distorting the distribution of income among the countries where the group conducts business. Next slide, please. And as an example that is quite realistic, I used to spend a lot of time in the automotive industry, and let's consider a situation where the parent company of a multinational group manufactures cars in Japan. Let's say it's a Japanese headquartered multinational group. The cars typically are sold to a marketing subsidiary, which we'll call Market Co, in the country where the cars are to be sold. And I'll just use as an example, Kenya. And then the marketing subsidiary, through dealers, sells the cars to members of the public. And but to avoid distorting income, Market Co needs to pay a fair market value, arm's length price for the cars it buys from Motor Co for resale. Basically, Market Co, the local in-country, Kenyan in this case, marketing subsidiary, needs to pay an arm's length market value wholesale price to the manufacturer in order to purchase the cars for resale in the market country, in Kenya in this case. And if Market Co pays too high a price, then income in Kenya will be artificially reduced and income in Kenya artificially inflated. So if Market Co overpays the Japanese parent in this case for the cars that it buys and resells, then the income of the distributor in Kenya will be artificially reduced. If the Market Co pays too low a price, then income in Japan will be artificially reduced. So next slide, please. So you can see the situation illustrated here. Motor Co in Japan sells cars to Market Co in Kenya, and if Market Co pays too much for the cars it buys from Japan, the Kenyan taxable income will be understated, and the Kenyan tax authorities will be upset. If Market Co pays too little to the supplier in Japan, the income in Kenya will be just fine. Its profits in Kenya will be inflated, but the Japanese tax authorities will get upset because Motor Co is being undercompensated for the cars that it sells from Japan. This is a very classic kind of transfer pricing situation, very simple one. And it was actually very important in the 1980s when the transfer pricing field actually grew up around disputes between the United States and Japan over the prices that were being paid for Japanese cars being imported to the United States. Next slide, please. Now, I just put on the slides a very simple scenario involving a very easy to understand situation involving the purchase of tangible goods, cars. Transfer pricing rears its ugly head in really an infinite number of transactions between members of commonly owned multinational groups. So it's very common, for example, if you have a marketing subsidiary in a country like Kenya, for that marketing subsidiary to pay the parent company or another group member we're providing various kinds of management services, accounting services, personnel services, and a great deal of, it's very important that the provision of those services be paid for at arm's length. Otherwise, again, the local country where purchasing the management services might overstate the price and squeeze the income, understate the income in the country, or it might conceivably overstate the price, and they basically shift income to the company performing the services. There are innumerable situations in which members of multinational groups provide R&D services to other members of the group, often setting up an R&D center in one country and having all the members of the group pay for R&D services to that centralized group member. A very, very important area of dispute and difficulty in transfer pricing consists of interest, of determining arm's length interest on intergroup loans. Very, very often, multinational groups have treasury centers set up in one country that make loans to affiliates all around the world. And if the interest rate is too high on those loans, the local companies reduce their income by shifting income to the finance company, to the treasury company, there's a very large degree of tax administration interest and difficulty in ensuring that countries don't overpay interest in order to shift income out of their jurisdictions. Very often, multinational groups have centralized foreign exchange management services, where all group members pay a central company to hedge the group's foreign currency exposures. And those are also very difficult to price. The price paid by the subsidiaries for obtaining these hedging services is very, very difficult to quantify, and it's been an area of substantial tax avoidance over the years. And also, this is true typically of manufacturing groups. Very often, the parent company or an intangibles holding company within a group will own the rights to patents and trademarks of the group, and other group affiliates will pay royalties to that central group IP company. And again, it's very, very difficult to figure out what the arm's length royalty should be, and it's a classic area in which companies shift income out of their local affiliates into a centralized part of the group. Next slide, please. And transfer pricing is a notoriously difficult area of law. What it requires is for a group of tax lawyers and tax accountants and economists to try to figure out market prices for goods or services where no actual market exists. And it's virtually impossible to do that. We've seen what happens. We saw what happened in, back in before the 90s, when the Soviet Union tried to have a set of market prices for transactions where no market actually existed, and it was quite a disaster. And there is no reason to think that the attempt to try to estimate market prices in the tax context will be any better. And in fact, it hasn't been. Transfer pricing has been for about 100 years now, and remains today a mess. And transfer pricing regulations worldwide attempt to solve this problem by reference to uncontrolled comparables. For example, and going back to that Kenya, Japan automobile example, theoretically, you should look at what in the market, what the wholesale price for cars is. But the problem is that in the actual market, there are no all transactions at wholesale of automobiles occur between affiliates of the multinational groups. And so there are no comparables for even the simplest kind of case where you of the automobile sold at wholesale. And certainly there are no arm's length comparables available, uncontrolled comparables available for things like the running of currency hedging services within a group and things along those lines. So the basic premise on which transfer pricing is based, that you can easily find a market price for things for goods or services transferred between related parties, has never been true. And it's been an area of law that has been crying out for reform ever since it was formulated in the 1920s by the League of Nations. It's a wonderful area to practice in because there are no answers to any questions. You can basically charge whatever you want to the client. And the difficulties of determining arm's length prices in related transactions lead to a very high level of transfer pricing controversies between taxpayers and tax administrations. Next, please. Now, there are various bodies of international law that try to attempt to codify transfer pricing law. The most important of which we'll discuss in a few minutes, are the OECD transfer pricing guidelines. Several hundred pages of dense type, which are supposed to help revenue administrators apply the transfer pricing laws. The transfer pricing guidelines set forth so-called transfer pricing methods by which taxpayers and tax inspectors are supposed to determine whether intragroup prices are arm's length. There's some of the buzzwords you'll hear are the comparable uncontrolled price method, the so-called CUP method, which we'll talk about in the context of natural resource products in a little while. The transactional profit split method, where you try to figure out how at arm's length the parties to a transaction would split the profits if they weren't related to one another. There's absolutely no way of determining that. And my favorite, the so-called transactional net margin method, or PNMM, in which under which you're supposed to use financial statement information available to the public from various companies, publicly traded companies, to estimate what the income should be of a particular company within a group. So, for example, if you're trying to figure out whether the pricing of that Kenyan automobile marketing company was arm's length, you would look in databases for the amount of income earned by uncontrolled distributors of motor cars in Kenya. And of course, there are no uncontrolled distributors of motor cars in Kenya, so the method is very unsatisfactory. It's an area of law that, as we'll see, is kind of plagues the international tax system. There have been many attempts over the years, and I've been kind of active in some advocacy on doing this, to replace the system based on the impossible search for comparables with a system of dividing income among members of multinational groups according to a formula. Say you would divide the income of a group among themselves by according to the relative sales volumes of the different members of the group. But formulary apportionment, as it's called, has never received a great deal of political support. And the reason, I think, and I'm a little bit biased in this, the reason is that transfer pricing is so unsatisfactory. The transfer pricing laws are so unsatisfactory. They allow an enormous amount of income shifting out of countries. And it really, transfer pricing is at the heart of the so-called base erosion and profit shifting problem, BEPS. And I think the world, despite all of the arguments for reform, has over the decades become kind of comfortable with the idea of profit shifting. And many actors, not only in industry, but in government, like the ability to provide, to reduce income in countries. It's a way of providing a tax incentive without doing so explicitly, and it's politically easier to do sometimes to allow profit shifting by tolerating unadministrable laws like the transfer pricing laws than by giving an explicit incentive like a tax holiday. So I think that this is one of those areas of life, and we all know there are many, in which things just don't work as they should, and you sort of have to stumble along as best you can as a tax administrator, or for that matter, as a transfer pricing expert in a private firm.
Michael, this might be a good place to talk a little bit more about formula apportionment, and maybe get the group involved, because a lot of people do advocate for formula apportionment, and on the surface it sounds like a wonderful system. I don't know how many people on the call are familiar with the two arguments, but not that I am tremendously in favor of formula apportionment, but I thought maybe I would take it up. I know Shanae has a comment on the in the chat box about it as well, or an indirect comment about it. And pillar one, for those of you that are familiar with it, is the project that the OECD inclusive framework is pushing for allocating income from digital businesses to market countries. And it has a form of formula apportionment, or it has formula apportionment as its way of allocating income. And I thought maybe, Michael, you could describe it in more detail, and we could go back and forth a little bit just about some of the good points and some of the bad points, and maybe touch base in pillar one in a little more detail, and get people involved, because it is kind of the current thing. Do you use this arm's length standard that's been around forever, which certainly has its problems, or do you use an alternative? And the only alternative that I'm familiar with that really has any support is formula apportionment. So I don't know, take a moment to describe formula apportionment in a little more detail, and then we can get into a bit of a discussion about it, because I do think that's where the arguments are going to develop over the next few years about transfer pricing, and whether it should be arm's length or formula apportionment, or some combination of the two.
Yeah, sure. You know, the states, the different states of the United States, and the different provinces of Canada, the different Länder in Germany, and the different cantons in Switzerland have for many years used, instead of the arm's length approach to transfer pricing, for internal domestic purposes, they've used formulary apportionment. And the experience in the United States is kind of instructive. It used to be that the formula was based on the relative distributions among the states of payroll, property, and sales. And now today it's almost entirely based on sales alone, the different sales volumes of the companies, of the group in the different states. And the reason that for the shift over the years is that the states didn't like the fact that if you hired people or invested in construction in a particular state, that would increase the taxpayers' income taxes. So the current standard in both the United States and in Pillar 1 is to apportion based on relative sales volumes, revenue in the different jurisdictions. The arguments against formulary apportionment have always been that you would need to have a single formula, a uniform formula for all countries of the world in order to avoid double taxation. And I don't think that is really true. Right now, under the arm's length standard, there is so much variation in the way different countries try to interpret the arm's length standard that you have huge amounts not only of double taxation, but of double under taxation when companies, when countries allow transfer pricing to reduce income in their jurisdictions. So I'm very biased. I've been writing about this probably for 20 years, and I've seen the arm's length standard work from both the governmental and the private sector standpoints, and it doesn't work. I'm convinced that the reason we still have the arm's length standard is that it is manipulable, and that both taxpayers and governments like that fact. And that's a very personal and somewhat contentious way of putting it, but I'm convinced Pillar 1 would indeed try to mitigate the detrimental effects of current transfer pricing rules by subjecting a portion of the multinational group's income to formulary apportionment based on sales. And also, although it's not usually emphasized, Pillar 1 also has a provision in it, a so-called Amount B provision that would very much simplify the application of the transactional net margin method to basically just kind of, without the need for a lot of economic analysis, determine fixed margins for businesses in different countries. Pillar 1 is not proven to be politically very acceptable to countries of the world, even though many of them have agreed in principle through the inclusive framework to support Pillar 1. I don't think there's very much likelihood that many, if any, countries are going to adopt it. And so I think this may be, Pillar 1 may end up being another example of an attempt to move away from the arm's length system of transfer pricing, which I think many people acknowledge is not working toward a formulary approach. But I don't think the world is ready for it even yet. And I think we'll be limping along under our current arm's length approach, unfortunately, probably for the rest of my life. Kind of a depressing thought, but.
Well, let me take the opposite side, not that I have a vested interest in it particularly, but you know, clearly the arm's length standard has lots of issues with it. I think, when you begin to argue about it, I'm not sure that the OECD is as cynical as you are about this standard, Michael. To be honest, I think a lot of people believe in it and think it can be made to work. It's not perfect, but it's certainly, in their view, better than the alternatives, I think. I think the problem with formulary apportionment, just to sort of get into it in a little more detail, if you look at developed versus developing countries and you accept the fact that the formula is going to be based solely on sales, what you get is a fairly large distortion. Maybe that's not the right term, but you don't end up with that much income in developing countries because of the fact that they do not have developed markets to the extent that developed countries do. And so the sales factor is really slanted against them. Whereas if you throw into the formula payroll and property, you might get a fair determination. And what I observed over the years in the United States is that the states, you may say they went to sales only, but I didn't perceive that. The states tended to favor whatever they thought was in their favor. And so you had various different formulas depending on the jurisdiction and what it felt favored them. And I think you'd find the same thing with the various countries around the world if you use formulary apportionment. I mean, clearly where you have a heavy workforce involved in producing something, but not so much of a sales factor, the country with a heavy workforce would argue that the formulary apportionment needs to include it. So there's a question about what the formula should be and who sets it, and is it standard or isn't it standard? The second thing is that in using formula apportionment, you really need to worry about what the group is, because that's kind of important. If you have a broad group and worldwide group, that's one thing. If you have less than a worldwide group, it's a different thing. And if you have less than a worldwide group, what is the group? Is it segmented along particular market segments? Should you include, in your automotive case, the finance company of the big automobile manufacturer and the production of the automobiles and their sale, or do you just use one or the other? And if that's an issue, then how do you resolve what is the common group for purposes of developing the standard? So that's a second fairly significant issue. The other thing is just the distortion of the formulas themselves. When you have sales, what is the sale? Is it the sale to the end person? Is it the sale to the intermediate person? What constitutes a sale? And when do you look at it? So, the people that love formulary apportionment are the ones that haven't had a chance to work with it, I think. And so in defense of the arm's length standard, it's a problem. I do not share your cynical view that the countries themselves are in favor of letting it distort things. There may be some, but I don't think that's necessarily a universal thing. But let me open it up to the group. I know there's some things in the chat box about this. The people you can either unmute yourself. I see Joy has herself unmuted. I know, Janae, you made a comment. Let me let me just open it up to people. Joy, do you want to make a comment on this?
No, not at this point, but I'll come back to it.
If you don't mind mixing it up a little bit right now and getting involved, I'm biting my tongue, refraining from responding to John. So hope that others will jump in to my defense. Well,
Janae, you had a brief comment and learn more. You had something in the chat box as well. Do either of you want to make a comment? Well, we have people that are. Janae, you're off mute. You're welcome to make a comment if you want to, or
yeah.
you don't have to take sides.
No, you got to take. You have to take sides. No one in transfer pricing doesn't take sides.
This is a debate. I lean, I think, towards Michael's side a little bit more. I actually wanted to hear, Michael, what your response would be to what John had said. Yeah, because I think the arm's length principle, like you've indicated, has been proven to be particularly problematic, especially for developing countries. And I think, John, to your point, there's discussions, right, around how the formula can be put together so that developing countries are sort of benefiting from that. So yeah, that's kind of where I stand. But Michael, keen to hear what your response to what John said would be.
I think that all the points that John makes are important, and there is no perfect way to apportion income among related parties internationally, and both of the arm's length system, I think, is deeply flawed, and formulary apportionment has its drawbacks too. But for example, one of the arguments which John mentioned is that if you do use it, that there are a lot of political factors that militate toward having a formula based on sales only, and wouldn't that perhaps shortchange developing countries to some extent? And statistically, because the amount of consumption in developing countries is relatively less than in wealthier countries, that's true. And this is a point the IMF has made in their analysis of formulary apportionment. But I think that even with the sales-based apportionment resulting in a somewhat smaller share of the pie for developing countries than might be the case otherwise, the current losses of revenue from profit shifting using arm's length transfer pricing are much, much greater than any revenue that developing countries would theoretically lose from a formula that didn't give them based on sales. So I think that, and I really admire a lot of the work that the IMF has done in this area. But when they make that argument, I just think they're being a little too short-sighted. The problems, the administrative problems of defining the group and the group to which the formula is going to be applied, the so-called unitary group problem, has been a difficult issue in the United States. And it will be a difficult issue under international formulary apportionment. And my only response to that is that I don't think it would be as bad as the current system. There are difficulties. I've given a more, I think, balanced assessment of this issue in a book that I wrote a few years ago. I'm going to plug right now. It's called Taxing Multinationals in Lower Income Countries. And it's available free. It's published by the International Center for Tax and Development. And it's got a chapter on transfer pricing that I think is a little less eyebrow raising than some of my comments earlier. But I'm purposely being a little controversial for effect here. But I do very much believe that despite the acknowledged drawbacks to formulary apportionment, at least it's theoretically doable. The notion of the arm's length notion of trying to estimate market prices where there is no market, I think is just theoretically impossible. And so it's intellectually a non-starter. Again, oh, there's someone in the chat here. But I do think that there are a lot of very valid policy concerns with formulary apportionment as well as with the arm's length approach.
Yeah, there is a comment from Lozola. I don't know. Do you want to expand on that? I wanted to throw out an example that I encountered in real life, but Lozola, you made a comment in the chat box. Do you want to?
Yeah, hi.
Hi.
Yeah, no, I'm listening to Michael explain and also, expand on the reasons why he thinks countries and companies are more in favor to the arm's length principle. And so I'm just thinking that apportionment could then be useful for trading services, which in my view is typically harder to price than trade in goods, obviously, because for goods, they often use some type of database that tells you more or less what's the price of the ore that's being mined. So apportionment may be useful for trading services, and then the arm's length principle could be applied to trade in goods. And then maybe, having both systems in place would sort of give you the best of both worlds.
Yeah, I mean, the current quote unquote arm's length system, there is a methodology called profit splits that can be used that in effect is a form of formulary apportionment. Let me give folks a real life example from the banking world, which is a little bit out of context of extractive industries, but kind of illustrates the problem both with arm's length and formulary apportionment. So if you're a large international bank, you provide a service for payments of not so much for individuals, but businesses to pay amounts cross-border. So you have a producer in one country and a customer in another. And the payment has to be made. Typically, there's two different currencies involved. So, the producer country will have one currency and the customer country typically would have a different one. So the bank sets up this payment system and the payments are processed in, let's say, Ireland. So they have a fairly large workforce in Ireland that processes the payments, a computer system set up there. And they also have a low tax rate. So there are various reasons for locating in Ireland, but certainly one is the low tax rate, but they also have a pretty good workforce and are conveniently located to the European markets. So when you look at this thing, there is that group in Ireland that processes things. The headquarters is back in the United States. So their headquarters people there, the systems people are in the United States that developed the systems, but they're adapted in Ireland. So there's systems people in Ireland. Then you look around the world and there are, let's say, 75 countries involved in this processing. In each one of these countries, there's a salesperson that is part of the process. In many countries where it's a relatively small part of the business, that person also spends their time doing other things. In the larger countries, it may be devoted to this process. And so what is the money that's made out of this process? Well, it turns out there's a fee for the service, but the reality is that a good part of the money is made on the exchange, the foreign exchange piece of the piece. And when you look at it, each transaction gives you a very, very small profit, but cumulatively, it can be rather significant. So you have a fee for the transaction itself. You have the foreign exchange profit. And then on top of that, you have a treasury element, which is based on the fact that the funds don't flow necessarily immediately from the producer to the customer. There's an intermediate short period of time. But when you aggregate all the funds together, it's kind of a free use of the funds for the bank. So you have these different elements. You have the treasury element, you have the fee element, you have the foreign exchange element. And now you say, how am I going to allocate the profit, which in some cases can cumulatively be rather significant, between the jurisdiction where the producer is, the jurisdiction where the customer is, the jurisdiction that processes the transaction, the jurisdiction that may have the treasury folks. And that gives you a sense of it. But I don't know, Michael, how would you use formula apportionment there?
Yeah, well, I think what you would end up doing is, aggregating all the profit and loss from these activities in one pot, and then subjecting them to the payroll, property and sales or sales only apportionment of the group. Is that theoretically valid? I don't know. I think it probably is more theoretically valid than attempting to figure out the arm's length prices for all of those, thousands of transactions that are accomplished. It's funny. I've had in practice. I had a similar situation to a very similar situation to the one you described, and formula. But the overall point I think that you make is, and I think is very important in the current context, is that not every situation is amenable to formulary apportionment. And one of the areas that is not, which we'll discuss in some detail in a few minutes, is the sale of a natural resource product from the mining or producing country to the marketing affiliate within the group that sells those products on to unrelated parties. The formulary apportionment doesn't work in the natural resources context. So even if you had an overall formulary apportionment system, and we'll see why in a few minutes, you would need to have a separate system for pricing natural resource product. Because the short reason is that when a country taxes a natural resource product, it's not really performing a taxing function. It's performing a sales function. So the country is actually selling those natural resources, and then determining what the fair market value price should be. It's pretty much impossible to escape an arm's length approach. So we'll see in a few minutes that nothing in this area is theoretically pure, and nothing in this area.
I will say I personally favor looking at the profits from a business segment and then determining, given that business segment, how you allocate those profits, whether you call it arm's length or formulary apportionment is a different thing. It's sort of a question of language. Christine had a fairly good comment in the chat box that when no matter what system you adopt, when you look at the ability of countries to monitor this, there's frankly a dearth of capable people to try to play a role in the process. I don't know, Christine, did you want to amplify your comment in the chat box at all?
Yeah, maybe just briefly, this is coming from a baseline study that we did for our domestic resource mobilization program a few years back. And this is just to agree with Michael's comments that we found this to be a difficult issue, and actually didn't even end up managing to take it up on our program because we thought it may be difficult to monitor. So yeah, we were finding that very few countries even have transfer pricing units in their revenue authority departments, and most of them just having some kind of legislation that provides for transfer pricing in their tax regimes. And what I'm saying is that I'm not sure if this is sufficient to, address challenges that have to do with aggressive transfer pricing practices. And just an example from Kenya is that, with the revenue authority, I think at the time we were doing the study, there was only about 12 people, employed or part of the transfer pricing unit, which gives you an idea that even when maybe we are carrying out things like tax audits, I mean, on average, it would take, 4 to 5 years to even complete a matter. So yeah, I think it became apparent that it was an area we may not be able to take on in the program. So I just wanted to raise that as an issue. I don't know, we did the study in 2019. I don't know if things have improved, but from the discussions, I think it's apparent that challenges still exist in this area. But thank you, Michael, for the presentation. Thank you.
Yeah, I don't want to pick on anybody, but I know we have some people from EY in the program, and I wonder if Lamori wants to speak too, but just to finish my thought, and then Lamori can talk. I know we have people from EY, and I don't know whether any of them are involved with transfer pricing or have some comments about their colleagues that might be so involved and what their thoughts are about it. But Lamori, why don't you go ahead? Your hand.
Yes. Thank you very much. I think I'm enjoying Michael's presentation. Issues of transfer pricing are complicated. Generally, tax issues are considered complicated. Now we have other methods of like the formulas, which are more also complicated. So I'm saying, looking at it, the issues of transfer pricing, to most developing countries, they are still sort of like developing that transfer pricing policies. And most of them, if I look at them, it's just like copy and paste, where they look at what other countries have done and just try to copy. But the problem of copy and paste, there may be certain conditions that may not suit your tax system environment. So number one, I wanted just to say these formulas are so complicated. Then number two, for these to work, they depend on exchange of information. I myself, I once worked for a revenue authority. One of the major challenges that we faced was to source information. I remember we once worked in a live case where the client had some related companies in UK and Mozambique. It wasn't easy for us to get information from the UK, for us to use those different methods, the CAP, the what, and so forth. So the fact that it was not easy for us to get information, so even to do the comparison using the transfer pricing is not that easy. Then my third point is, now people, other revenue authority and other countries, people have now begun to study on transfer pricing, and you are now being told that no, transfer pricing is not working. just imagine when some people are now beginning to maybe do some programs and order so that they get the capacity. Now the word that is in the street is that transfer pricing is not working. So some people are a little bit confused whether to proceed with capacitating themselves to have a better understanding of transfer pricing, or to stop and begin to focus on pillar 1 and pillar 2. So that brings me to pillar 1 and pillar 2. So when it comes to pillar 1, it's sort of like this sort of a discrimination. We've got taxpayers in country, let's say A. So a certain taxpayer is taxed based on residual profit in that country, whereas the domestic taxpayers are taxed on profit. Isn't there some sort of discriminatory to say when you're a multinational company, for you we only use the residual profit? That's what pillar 1 says. But anyway, we appreciate at least now that they've accepted that market do influence profits. Now coming to pillar 2. Pillar 2, yeah, the challenge is pillar 2 is, yeah, it's mixed. Yesterday I think we spoke about it a bit about it, but the challenge is, I know there are certain African countries which are charging effective tax rates which are below 15%. So for those countries which are charging effective rate which is less than 15%, it sort of like reduce those low tax rates. But for those countries which have effective rates which is above, I remember yesterday HNI was when she comment when say it ranges from 25 to 30. This 15% won't be useful. Now, another issue that I want to comment concerning the transfer pricing, it seems that sometimes there is no political will or political support. If you look at the G20, even the presidents for those countries, they are in the forefront in terms of, proposing those, formulas. But when it comes to the developing of the global south, it's only the technical people who are at the forefront. So if those technical people fail to convince their political leaders, then this issue won't be bought. I'll give example in Zimbabwe. It's very rare to hear the Minister of Finance speaking about transfer pricing. It's very, 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 very rare. So I just wanted to, to highlight some of these points. I hope maybe they're useful. Otherwise, thank you very much, Michael.
Yes, thank you, Lamar. If we have time at the end of the transfer pricing discussion, since we may have a little extra time today, I think maybe, Michael, we can spend some time talking about pillar 1, pillar 2. It's not otherwise on the agenda. In any event, we have more hands raised. One hand just went down. I guess Lena, you had your hand raised. Do you want to make a comment?
Yeah, sure. I'm Nilena from EY Kenya. I wanted to add a point to what Christine said. Yeah, for sure, our transfer pricing, the transfer pricing department in our revenue authority is relatively slow. There are 12 people, like she said, but it's one of the most robust in the country, in the region. However, you would see, so they're quite robust to other multinationals, but for extractive sector, what you would see is like what we mentioned yesterday, and most of the contract entered for extractive sector, you'll find they have a clause which would be, say, paid on behalf, such that the government pays on behalf of the extractor, of the investor. And so transfer pricing mostly won't apply, because if the taxes have already been paid, then the risk becomes quite low. So our issue mostly comes with yesterday's issue of how the contracts are normally negotiated. That's the point I wanted to add.
That's a very important question. We'll be spending some time on that later in this discussion. But I think you're right on point there.
Okay. Here's does anybody else have a comment? There was another hand up and I lost lost contact with the person, but I don't see any other hands. Michael, before we get into do you have some more slides on just general things before we get into extractive industries? I'm not quite sure where we stand in that. I thought we'd have a break after the general discussion before we got into extractive industries. So where do we stand?
Well, I've got about another 20 minutes of slides on general stuff. And,
Okay, why don't you do that? Let's do that, have a discussion if people want on other points, and then we'll have a break and get into extractive industries. How's that sound?
that sounds great to me.
Okay.
I just want to fill in. So does someone else, someone wanting to speak?
I don't see a hand up.
Okay, I thought I heard something, but in any event, in the late 1980s, transfer pricing became very controversial in the United States, largely because of something that has nothing to do with natural resource taxation. In the late 80s, in the second half of the 1980s, the United States was importing a great number of cars, automobiles from Japan. And during that period, the value of the Japanese yen relative to the dollar appreciated very substantially. The yen became a lot more valuable, and it became impossible to make things like cars in Japan and then sell them at a profit in the weak dollar United States. And this caused the North American operations of the big Japanese car companies to have very low, relatively low profits and sometimes even losses. And the US Internal Revenue Service felt that those losses should be shared between the United States and Japan. The Japanese National Tax Administration felt that I'm sorry, the yes, and the National Tax Administration in Japan thought that this was the lower income was caused by market conditions in the United States, and that the U.S. affiliates of the marketing affiliates of the Japanese companies should not be treated as earning a profit in the United States. And there was a great deal of negotiation between the U.S. and Japan on this, and I was actually involved in those negotiations for the IRS. But in the interim, because there was some resentment of the success of the Japanese manufacturers, automobile manufacturers anyway, political resentment in the United States, this became a political issue, which it rarely is, a popular political issue. And it was felt that the IRS was losing a lot of money to transfer pricing manipulation. And so there were various attempts to try to come up with more effective enforcement mechanisms. And the leading one was the requirement that taxpayers prepare and provide to tax administrators on request so-called contemporaneous documentation, sometimes called transfer pricing documentation, explaining their transfer pricing policies. And what happened though was, and it's still a requirement, it's all around the world, all countries everywhere require transfer pricing documentation. And what happened though is it quickly became this really bulky document, well over 100 pages long with all kinds of statistical analyses that no one could read. And it proved not to be very useful to tax inspectors. And in fact, at some point, one point, the head of international practice at the Internal Revenue Service had to issue a directive to tax inspectors in the US actually to read the documentation instead of ignoring it, because it really didn't prove to be very helpful to enforcement. And in addition to transfer pricing documentation, many countries have special portions of the corporate tax return that require taxpayers to give detailed lists of the related party transactions, which is actually pretty helpful to an examiner. And there's an international requirement now coming out of the BEPS initiative from the OECD for so-called country-by-country documentation, in which your transfer pricing documentation is supposed to specify in which countries of the world your income is in fact taxed. This, I think, was, I question the utility of this. I think everyone knows where everybody's income is taxed. It's very easy to find that out, but politically, it's been a very popular move in some quarters because it kind of publicly exposes what some people view as transfer pricing manipulation. So anyway, documentation is talked about a lot. It's a big business center for consulting firms. But it's probably not as important as some might argue.
Yeah, there's a big movement to have country by country reports made public. The industry, or many companies, resist it. Frankly, my experience in producing those reports for the banking industry was there wasn't anything terribly interesting in them, and reviewing them wouldn't be of any great hardship to the companies. I think the fear is that if you revealed it, country A would see that country B was making more money or paying more tax. The company was paying more tax there than in country A, and there'd be a revolution amongst not just the governments, but people's civil society organizations commenting, what have you. In any event, there is a movement to make a lot of the documentation public. The EU is leading that to some degree, and I suspect over time, a lot of that will become public.
And next slide, please. Oh, and just some materials to read. The main body of international law in transfer pricing is the OECD Transfer Pricing Guidelines for Multinational Enterprises and Tax Administrations. Several hundred pages long, were originally drafted in 1995. They've been updated since, as really by I think a lot of people who were intent on defending arm's length transfer pricing against proponents of formulary apportionment. And it's a very bulky document. It's worth reading, I suppose, if you're going to be working in the field. I question how much actual guidance useful guidance it provides for tax inspectors. There's, oh, no, I'm sorry. We should go back. There's also the United Nations Tax Committee has its own lengthy as well practical manual on transfer pricing for developing countries. It's very repetitive of the OECD guidelines, but still, but I think if you're going to be deeply into the practice and politics in this area, you need to be familiar with them. Each country, since the OECD transfer pricing guidelines are not statutes, so some countries have actually adopted the OECD guidelines as national statutes or regulations, but other countries have including the United States, very extensive transfer pricing regulations that largely track the OECD guidelines. And there's also an important document, the UN Handbook on Selected Issues for Taxation of the Extractive Industries by Developing Countries. And this has a very good chapter, I think, on transfer pricing, and it's actually readable. So I'd recommend that. Next slide, please. Since the 1960s, it's been virtually universal for large multinational businesses to employ what used to be called the base company structure, and in the last 30 years has come to be called the hubco structure, hub company structure. And it's a structure that's that's designed to take advantage of the uncertainties of transfer pricing. And this involves setting up a company in a low or zero tax country like Bermuda or Mauritius or someplace like that, to serve as intermediary in related party transactions. So as we'll see in a few minutes after the break, it's virtually universal for natural resource companies to set up marketing subsidiaries in low tax countries, maybe Switzerland, maybe Bermuda, in which, so that when you sell, when you mine ore, say in West Africa, iron ore in West Africa, the mining company sells that iron ore not immediately to unrelated steel companies, but instead, on paper anyway, sells that ore to a hubco called a marketing company in the natural resources field in a lower zero tax country. And that hubco sells that ore on at a profit to the customers around the world. In fact, the ore never physically touches the hubco country. It's all done on paper. But theoretically, that hubco is performing marketing services for the group, and it's argued that it's entitled to keep a certain amount of the income in return for its services, which of course reduces the amount of income that's taxed in the country where the mining takes place. And this hubco structure is, again, it's virtually universal. All kinds of intergroup transactions are run through hubcos, including provision of services, the sale of equipment, mining equipment, whatever. And it's a structure that is made to shift, it's designed to shift income into the lower zero tax country. It's been at the heart of the whole BEPS discussion in the OECD. And as someone suggested earlier, much of Pillar 1 and Pillar 2 can be seen as trying to make up, trying to put a break on the use of limitations on the use of hubco to avoid taxes, hubcos to avoid taxes. And we'll, as John said, we'll talk a good deal more about that. But I just, before we move to discussion of natural resources specifically, I wanted to introduce the concept of the hubco, because it really is at the very center of tax planning, multinational tax planning today, and it has been the case since the 1960s, really. So it's really the context in which one should understand how transfer pricing really works in practice. John, are you monitoring the chat?
Yeah, I have. There's an interesting comment in the chat box by I think it's Geraldine, and she may want to expand on it about confidentiality clauses. I don't know, Geraldine, did you want to comment on that? I thought it was an interesting comment.
Can you hear me?
Yes.
Okay, thank you. So basically, This is all new to me, so I'm kind of asking questions at this point. In developing countries, for instance, in Kenya, we can see that extractive industry contracts usually have confidentiality clauses where some things cannot be revealed to the public for scrutiny. Someone mentioned how these contracts are usually negotiated. It's very secretive. And I was wondering, since it has been mentioned that in transfer pricing, most of the times you find that you need a lot of information as to what is being exchanged, what is being sold, considering that most of the companies that usually undertake the business in the extractive industries in developing countries are usually foreign countries, which now use their means and their business to do their business now in developing countries. So due to those confidentiality clauses and the secretive manner in which these contracts are reached, does it not make it difficult then for even any transfer pricing compliance to be checked? Because all those things are just all the secrets and the confidentiality makes it difficult for taxation compliance to be done.
Well, you know, I'm not sure that the confidentiality clauses make it add that much difficulty to tax enforcement, because even though the financial information is not available to the public, tax administrations can still request it and compel production in the course of an audit. So, but I think the bigger problem with the extensive use of confidentiality in connection with mining contracts is that it makes it hard for the public to know the terms under which a country's natural resources are being sold. And so now there is some instances, there are many instances actually, I've certainly experienced this, where companies will try to resist giving information to tax inspectors saying, well, that information is in country A, and your audit's in country B, and we don't, by policy, we don't share that information. I think a lot of countries now have rules, statutes, laws that say that a company that does business in your country needs to provide tax information with respect to all of its related parties elsewhere. So I don't think it's as big an issue as it used to be. But the bigger issue on terms of confidentiality is simply that these are, these natural resource contracts affect the public greatly. They involve, maybe the country's greatest source of development, potential development, and that the mechanics of these contracts should be well known. There is an organization called the Extractive Industries Transparency Initiative that in member countries, and there are a fair number of them, will publish the contracts after they're negotiated, but that still leaves the problem of how public might get input into the actual negotiation of these contracts, and no one's solved that problem yet.
Yeah, let me just add a comment, and maybe Shanae or Makupa from Tax Justice Network Africa would comment on it. But I think one of the problems of lack of transparency isn't just with the public, it's also when you look at the government of countries, typically there's the executive branch that's the one that's involved in executing the contracts, the legislature, and then the judiciary, and then of course the public. In many cases, the legislative branch is kept in the dark. And so and they may be presented with the contract at the end of the whole process, which really puts them in a very difficult position to enter into the discussion in a meaningful way. And sometimes they may not even see some of the terms of the contract. So the question of transparency is a significant issue, not just for the public, but sometimes for members of the legislature and other parts of the government as well. I don't know, Makupa or Shanae, if you wanted to add on that, but I know that some of the parliamentary groups that you work with, that this is an issue for them.
Hi, John. Yes, indeed. For example, like I think I referred to the Liberia case where the deal was just brought to them to sort of rubber stamp. And they do complain of not having the adequate resources in terms of the research, the knowledge to sort of make an informed decision to scrutinize the deal. So most times the legislature is indeed just there to rubber stamp, and the executive is obviously pushing its interests, whether it's a few members who have side deals with the company and and are also getting kickbacks and so forth. So I think that's the biggest challenge we've seen, and that's why we're working with parliamentarians directly. So yes, indeed, it is a challenge.
Okay, thanks. Let's see. There are a couple other comments in the chat box. I don't know whether, Luzola, you want to expand on your comment or not. Anyway, nice comment.
I was just,
yeah, go ahead.
yeah, no, I was just providing some information that there's a lot of African countries that have online, what they call online cadasters. Sorry, it's basically like, apologies. It's basically like online you know, system websites that host the contracts that the mining minister or mining department awards, especially in countries, I think Kenya has one of these. It's especially in countries where licenses are granted. So not necessarily countries that follow the contractual system. I'm trying to think of the word where the licenses are granted. It's not called a contractual system. It's the other, anyway, the other type of, of system where they grant licenses instead of signed contracts. But obviously within this granting of license, a sort of contract is signed, and it's usually a model agreement that is in the law. So those contracts are usually accessible to the public on these online platforms. Alternatively, a lot of countries have access to information laws, and these laws usually allow affected parties such as mining communities, host communities, or labor sending communities, and civil society organizations or NGOs to request the mining contract to view it, or the mining license to view the license conditions, or at least to request specific provisions that they think is relevant to whatever query they want to raise. The EITI is of course there, but there's several African countries that are not members. I think majority of extractive countries in Africa are not members of the EITI.
Yeah, I think you were referring to concession systems earlier versus contractual arrangements.
Yes, thank you for the word. It slipped my mind.
Yeah, I think in some countries there's a, you know, a legislative framework that creates the right, not the right, but the opportunity for people to, firms to bid or contract separately on different kinds of extractive industry types of engagements, and they would get a concession arrangement from the government per the legislation that's set up for it. I know, Michael, let's finish up on the general stuff, take a break, and then we'll go into specifics on extractive industries. Did you have anything more on?
Well, let's see on the screen now a slide of something we actually covered, which the point I wanted to make is that a very large amount of intergroup transactions of all kinds are run through hubcos, and we don't need to revisit that. I think, what is the next slide, please? Okay, could we go to the next slide? There we go.
Should they go to the next slide after this one?
Yes, the next slide has got a diagram, yes.
Is that one okay?
This is actually a good place to break, because now we are moving into the specific context of natural resource taxation and transfer pricing. So John, would you like us to take maybe a—
Yeah, why don't we take a 15-minute break? And we'll convene again in 15 minutes. All right. Thank you very much, Michael. It was great. The discussion with the people in the participants was one. Are you ready to begin, Michael? I'm not sure where you are.
I am. I just had enough coffee to keep me going. The rest of it.
Finish your breakfast.
Yeah.
Okay, I think we, unless anybody has another comment they want to share before we begin about general things, we're going to move into specifics of transfer pricing for extractive industries. And in some ways, this is the most important thing in terms of at least determining profits for tax in a particular country. Okay, Michael, please.
One comment about transfer pricing and corporate taxation in general. You know, there is no real solution to the problem of dividing income among the jurisdictions in which a multinational does business. It's an insoluble problem, because it is impossible to estimate market prices very accurately in the absence of real market transactions. But the transfer pricing problem, the formulary apportionment problem, whatever you want to call it, is an inevitable consequence of the decision to tax net income rather than gross income. You know, you can envision a situation where we would not try to have a corporate income tax. Countries would instead increase their consumption taxes, or would impose taxes on the gross revenues of multinationals rather than try to determine their net income, which is where the whole transfer pricing problem arises. And the problem is that from a developing country perspective, there really is no substitute. There's no way of doing without the corporate income tax. Developing countries simply couldn't afford to sacrifice the tax base that they generate from the inbound activities of multinational business. And you really can't I think it's generally agreed that you can't wholesale substitute a gross revenue tax for an income tax, because gross revenue taxes place the taxpayer at a very substantial economic risk of having to pay taxes without having profits. And that's the reason why, you know, throughout history or modern history, there's been an insistence on corporate income taxation rather than some other form of gross revenue taxation. So this is just one of those areas in life where things just don't work very well. And you know, who knows whether the right answer is some kind of formulary system or some kind of simplification of the arm's length system. I think none of us know that, and neither solution is going to be that easy. But we just have to acknowledge that it's going to stand. We're going to remain far from perfection in this area of life. And so it's always going to be challenging. And if one wants things neat and clean, one should choose a profession other than transfer pricing. But in any event, why don't we move on now to the specific issues in the natural resources field. As you see on the slide, the structure that's used by a great many. I'm not sure I'd say virtually all, but certainly a great many companies in both the oil and gas and mining fields, which is the use of a hubco marketing company. And what basically happens is that the multinational mining company or oil company extracts product in the local country, and then the important important question for both the application of the corporate income tax and the royalties, whatever royalties might be owed on the product, is the price at which that product is sold to the marketing company, which is invariably set up in a low tax jurisdiction or zero tax jurisdiction. And then the marketing company is the entity that on paper sells the product to the final customer. And the big question for tax purposes is how much profit is the marketing company entitled to keep for tax purposes and therefore to avoid paying taxes on. In fact, these arrangements exist only on paper. The product actually is shipped directly from the local mining affiliate to the customers. Last title, a very brief legal title, typically passes to the marketing company while the product is in the course of shipment. But in reality, in physical fact, the sale is made directly from the local affiliate to the customer. But in terms of the contractual relationships, the hubco takes ownership briefly and resells the product. Yes, and someone was wanting to speak.
I don't see anybody, Michael.
And you know this.
I don't know whether there are a few people off mute, but not sure anybody wants to say anything.
Okay. And then this puts a great deal of pressure from a transfer pricing standpoint on the price at which the product is sold first from the local mining affiliate to the hubco. The taxpayer is going to have a tax incentive to try to understate that price, to understate the value of the product as it leaves the mine and is shipped to the customer. Because the lower the price to the local mining affiliate, the greater the profit that ends up in the tax-exempt or tax-free hubco marketing company. And this is really what this is the area that is specific to mining companies. So this is and it really defines probably 90% of the effort that tax inspectors need to put into ensuring fair taxation on the part of the local mining affiliate. Next slide, please. And the important conceptual question is whether the marketing company contributes sufficient value added to justify the markup that it earns or to justify any markup. And as a practical matter, the widespread use of marketing hubcos makes it very important for the tax administration to ensure that sales of products to the marketing company are made at fair market value, arm's length, not at a below market price. Next slide, please. And now, what's the legal setting in which all this happens? The arrangements by which the host company government raises revenue from extractive products are typically set forth in a legal instrument between the government and the mining company or the oil company, and are called the fiscal regime. For some oil and gas projects and almost all hard rock minerals projects, the fiscal regime requires the taxpayer to pay both royalties on the value of product that is produced and corporate income tax on the profit from the taxpayer's extractive operations. The valuation of product is, of course, central to the administration of both the royalty and the income tax component of the fiscal regime. Next, please. Now, in the oil and gas and sometimes natural gas industries, another kind of fiscal regime is commonly used. Production sharing agreements, PSAs, sometimes also called production sharing contracts. PSAs entail a sharing of product revenue between the host government and the investor. Basically, PSAs set up a partnership between the government and the mining company, which is typically actually a group of, oil and gas company, which is typically a group of oil and gas companies. The valuation of product is necessary under a PSA to ensure that each party receives its intended share of revenues. The product as it is pumped and assigned to a particular party to the agreement has to be valued at that point. And so you have a valuation issue under PSAs as well as under mining concession agreements. Next slide, please. And I want to show how important the valuation of product really can be, and even small variations in the valuation of product can lead to very large tax deficiencies. Consider a taxpayer in a mining industry operating in a country that has a 35% corporate tax rate. Assume as well that the correct fair market value of product extracted during the year is $100 million, and the company's deductible expenses are $90 million, so that the company's correctly measured taxable income is $10 million, and at the 35% rate, its correct income tax is $3.5 million. Assume now that the company understates the value of this extracted product by 5% or $5 million. The government's income tax revenue is reduced from $3.5 million to $1.75 million. It's cut in half, a reduction of not 5%, which was the understatement in the product price, but of 50%. This shows how even a small understatement of tax can lead to a very large understatement of income tax revenue. Now, this is mainly this kind of thing is mainly a feature of the, excuse me, of the income tax. If for royalty purposes, if the value of the product is understated by 5%, the value of the royalty, the amount of the royalty only goes down by 5% as well. It's because the income tax is imposed not on the gross amount, but on the margin, the profit margin of the company. And you have this magnification of even small price discrepancies into very large tax deficiencies. And every country has to come up with its own mix of royalties and corporate income tax. One lesson here is that the greater the emphasis placed on royalties, the lower the tax risk for the government. However, the greater the emphasis placed on royalties, the greater the risk is borne by the investor, because the investor has to pay royalties even if they don't make a profit. So there's always a tension there between royalties being a lot easier to administer and the income tax being more satisfactory from an economic standpoint. It's an unresolvable tension. There's always a mix.
Yeah, I will say, Michael, in some cases, particularly in the oil and gas industry, the country owns the resource and title passes at the flange, so to speak, where the crude oil comes up out of the pipe And the licensee, the oil and gas company, then takes title to the crude oil. So title passes at the flange is what they say. And in some cases, where there is extraordinary conditions, like there are today with wide price variations in oil and gas, the title passes at the flange in one price, and then the company that the off-taker, so to speak, that takes the product can turn around and sell it all instantaneously in some cases to another company at a fairly significant profit. And it's sort of an interesting transfer pricing situation there. What is the right price at the flange? Even though the parties are unrelated, there's still a transfer pricing issue in terms of setting the price. Even different kind of factual situation, but one that's not of a lack of importance.
Well, actually determining the point in the production process at which the product is sold and valued is an important complication in trying to do an arm's length valuation of that product. I mean, for example, iron ore might be sold in ore form, in raw ore, or it might be sold in pellets, and the prices will be different, arm's length prices. And there's actually a lot of tax inspectors spend a lot of time on figuring out the right price for the particular stage in production.
Yeah, I think there's a huge movement as well for, particularly in developing countries, for more processing to be done in country.
Yes.
Versus elsewhere.
There's a question in the chat asking whether I can elaborate more on valuation of extracted product, and yes, we will do that quite a bit. More specifically on PSAs, I really haven't distinguished in this presentation between valuation for PSA and for concession contract purposes, but we could. And there's really actually not much literature out there on that distinction. But one place to start might be that UN handbook on taxation of the extractive industries. They talk a good deal about PSAs in that manual. Okay. And then someone typed, wow. We're gonna get out there and
that was on your example, the example that's on the slide. Yeah, it is an interesting point that you raised there about the price shifting, the impact of net income versus a royalty that's based on gross revenue in some fashion. Obviously, the impact is greater on the net basis than on the gross basis.
I think Angie had a hand raised.
Angie made a comment, but go ahead, Angie.
Yeah, thank you, Michael. Thank you for this very useful presentation. I just wanted to know whether the production sharing agreement is included in the mining conversion agreement, or are these two different documents?
Oh, well, they're all generally, although there are some exceptions, production sharing agreements are used for crude oil. And I think also to some extent for natural gas. When PSAs are used, there's no need for a separate concession agreement. It replaces the concession agreement or the MDA, the mining development agreement, which is typically used in hard rock mining, hard minerals mining. And does that answer your question?
Yes, sure. Yeah. Maybe I can add one more.
Sure.
Okay. Let's say a scenario whereby, like currently in Burundi, the country has suspended all mining agreements because they were claiming that they are not getting enough benefit from the mining activities. And the taxation regime is based on a specific taxation of royalties and taxes, and the common or corporate taxation regime. Still, the country is claiming plus 10% of equity share in the mining company. So the country being claiming that it's not gaining a lot from the mining activities. Do you think there is any other alternative to this situation?
You know, I need to know a lot more of the factual background, and particularly why the government feels that it's not being adequately compensated under these agreements. There's been a lot of political frustration with mining agreements throughout Africa, and there's a feeling that many of them that are in operation, many of the agreements that are in operation today were not negotiated effectively by the government. They were really outmaneuvered by the companies, which typically have a great deal of resources to apply to the negotiation. In terms of the specific situation in Burundi, I just am not familiar with it. But I know that there, as Sinead was saying, there's a similar feeling about a recent iron mining agreement in Liberia, and that agreement's been put on hold for renegotiation. So yeah, I mean, it's probably, you know, it would be very interesting to learn more about Burundi.
Yes, sure. Maybe we'll continue this discussion later on.
Yeah.
Thank you.
I have been in Burundi, and not on a mining related thing, and it's a very beautiful country. So if you don't want anybody to come there and join in on this, let me know. So.
Okay, sure. Thank you.
Okay, well, next slide, please. Okay, what kind of method, transfer pricing method, do you use to value the product that's sold from the mining company to the marketing company? And this is an area. This is an area of transfer pricing that's always going to be done under the arm's length basis. There's no real sensible way of doing formulary apportionment in the extractives area. And so the method that's used is the comparable uncontrolled price method, where you try to find market prices for the stuff that is for the product that's being sold in the control transaction within the multinational group. And a starting point for coming up with the market price for natural resource products sold from a particular country and under particular circumstances are the so-called posted prices, like the Platts price for oil and some other minerals, the London Metals Exchange price for various metal ores. And you can look up in the newspaper online and every day the posted price of oil. In fact, some people or other commodities, some people follow them very, very closely. They invest in them. But the existence of a posted price, unfortunately, doesn't solve the transfer pricing problem. It helps, but it doesn't solve the problem. Because for any particular oil field or mine, adjustments almost always need to be made to the posted price to determine fair market value. And these adjustments can be very difficult to make. Adjustments often must be made, for example, to account for product impurities. When pricing, say, iron ore, there's a lot of very wide range of variation from the posted price depending on how much water is in the ore. And that can vary not only between countries, but the amount of the water content of iron ore can vary even within the same mine. You get it from the west side of the mine and there's a lot of water in it. You get it from the east side of the mine and there's not that much water in it. And so you always have to make adjustments for product quality, which can be very difficult to make, require a lot of engineering judgment. And also, this is very subtle, the duration of the, well, this is not so subtle, distance of mine or field from market. Posted prices are set assuming that you pick up the product at a particular location like London or Singapore or wherever, based on depending on the commodity that you're dealing with. So you have to adjust the posted price to adjust for the distance of your own particular mine or oil field from the market point. And you also need to make adjustments for the duration of the contracts under which the product is sold. And this is a very difficult thing to information to get. I mean, if the taxpayer is reselling the ore, say, under a 2-year supply agreement, the price will be very different than if the value of the ore will be very different than if the taxpayer were selling the product under only short-term contracts or spot sales or whatever. So the amount of all these adjustments to the posted price can be very material, and they're also extraordinarily difficult to make. You basically, especially for the ore quality, you need expert engineering advice, and also for determining the contract duration, you have to get a lot of information from the taxpayer, which can be very difficult. Next slide.
Before we move on, John Akira had a question in the chat box. I think you probably answered it, but I don't know. John, did you want an amplification of your question?
Hello.
Hi.
Yeah, John, thanks for the presentation so far. My question was about the formula for determining royalty. Do we have a formula, or a country determines its own base of determining how much royalty should be awarded to a given community where the resource is identified? And what would you recommend with your experience? What should be the basis, meaning how much royalty should be maybe awarded to a given community where the oil resource or a mineral is found or discovered? I wanted your own perception on this.
You know, I really don't have. I've never done a quantitative study that would enable me to sort of recommend a particular percentage of the fiscal regime, the government pay that should be royalties, and what percentage should be corporate income tax. My sense is that over time, because of the desire to reduce investor risk or perception of risk, that formulas have become overly weighted toward the income tax and insufficiently weighted toward royalties. But in terms of the actual numbers that I come up with, I'd really need to listen to others on that and have a lot more quantitative understanding. It's a very good question, and not one that I find people are all that willing to generalize on, all that willing to give opinions on. There's a lot written by the IMF on this kind of question, and I don't think that they come up with a standard formula that they recommend.
Yeah, Rachel had a question too about, at least this pertains to the determination of income. Why does the distance matter if there's going to be a charge for the transportation and then, or a deduction for the transportation expenses? I don't know, Rachel, did you want to amplify on that?
That's a good question. If there's a separate charge, you don't have to back it out of the price.
I think that's a question, right?
You have to you have to I'm so sorry, I was looking at something else in the chat. You have to make sure though that you're using an accurate and not an overstated transportation adjustment. Someone asked for my email address here. Why don't I put that in the chat while I'm thinking about it.
Yeah, I think actually, Michael, your email address is in the emails I've sent to people, the CC address line, but go ahead and put it in the chat.
All right. Well, very good. And if you're interested in the book I so fulsome, my book that I so carefully advertised a little while ago, just let me know and I can send you a link to it. Next slide, please. So even where posted prices are available, and they are available for many, not all, but many products, transfer pricing for the extractive industries requires difficult physical monitoring and the exercise of subjective judgment. I mean, basically, assayers or engineers with the expertise in mineral evaluation, in many cases, need to look at the actual particular load of ore as it comes off out of the mine, and make some judgments as to valuation. And now, in some circumstances, like with gemstones, posted prices are of limited value, and product needs always to be appraised on an item-by-item basis. And this means that the tax administration basically needs somehow to get the services of appraisers to ensure that it's getting fair value for the product. And again, remember that in economic reality, what's happening in the extractive industries is that the developing countries are selling their resource heritage, and it's any seller is going to want to be certain that it's getting a fair price for the things that it's selling, especially when they're non-renewable resources and they're being held essentially in trust for the people of the country. So it's a very kind of tense and demanding area of activity is doing the tax enforcement and administration in this area. Next slide, please. And because of the need for subjective judgment and the large revenue consequences of even small product undervaluations, transfer pricing controversies in the extractive industries can be very difficult to resolve. They happen all the time, and they're really difficult to settle or to resolve and to adjudicate in court. And the nature of the uncertainty and of the return filing process under the corporate tax, or generally under taxes, makes these disagreements even more likely. When there are legitimate uncertainties in product valuation, it's simply natural for the taxpayer to come up with a very low valuation on its tax return. The fact that the taxpayer is the first mover creates something of a presumption in favor of the taxpayer's views, regardless of whether under the law the taxpayer has the burden of proof or not. In practice, it's up to the tax administration to come in and challenge that price. And now when the tax administration challenges the arguably low price reported by the taxpayer, the tax administration is also going to very likely resolve uncertainties in its favor and demand a substantially higher price, maybe higher than is appropriate. And these are genuine controversies. You know, sometimes people talk about whether transfer pricing deficiencies in this context represent illicit transactions, illicit flows of funds. And, you know, I think there's, you know, maybe it's because I'm a lawyer and I've been involved in these kind of things. I think that good faith behavior on the part of both taxpayers and tax administrations can set up very difficult controversies that can get people really upset. It's built into the landscape, and it's just a manifestation of that general imperfection in life of not being able to estimate market prices with precision in the absence of a market. It has very troubling consequences, and unlike other areas of transfer pricing, I don't think we can look to formulary apportionment to get us out of the problem. I think we're stuck with this comparable uncontrolled price approach to minerals valuation. Next slide. Here there are some administrative approaches to avoiding disputes and reducing disputes. There is administrative pricing under which the government sets the price of the product, market price of the product for purposes of taxation and royalties. The Norwegian government has been doing this since the 1970s for North Sea oil. The Norwegian government has a big office of petroleum valuation, and it comes up with quarterly prices for oil from each of the separate North Sea fields. And it's been running by and large. Both taxpayers and the government have respected the prices set by the prices set under this arrangement, and it's viewed as a model, but it only extends to oil prices. It doesn't even extend to natural gas pricing from the North Sea oil fields, because oil is probably among the most uniform in terms of product quality of natural resource products, and the North Sea fields were at least so dominant in the business and economically that it was relatively easy to make things like contract duration adjustments and allowances for transportation. But the administrative pricing approach under which the government sets a product price which taxpayers must accept is possible. It's been done successfully for crude oil only since the 70s for North Sea oil. I understand that a couple of other countries, including I think Angola and Indonesia, have applied similar approaches, but I'm afraid I'm not as familiar with the details of those as they should be.
Yeah, I will say, Michael, I haven't been involved in the oil and gas industry for quite some time, but when I was involved, the U.S. also set prices for various kinds of crude oil, and they had a whole group doing it. And when I was involved in some pricing issues, we met with that group of people. So they would set the price for West Texas crude and things of that nature. Similar kind of arrangement. I think in some cases the government's doing it and they actually own the resource. In other cases, it's just a price setting mechanism, primarily for tax purposes, but I guess it could be used for royalties as well.
Thank you. I think that the IRS, sometime over the past 15 years, has actually eliminated its petroleum engineers. That I don't know the details of that, but I should check.
No, it could be. I was involved quite some time ago, but they were quite active when I was involved.
Huh. Yeah, another approach is similar really to administrative pricing is for the government and the taxpayer to agree to abide by valuations from a designated third-party independent appraiser, engineering office, consultancy, whatever. And that I believe is done to some extent, although I'm not sure that there's a good, very much detail out there in terms of governmental practices. I'm actually, as a member of the UN subcommittee on natural resource taxation, I'm trying to get a project started in the UN to develop a lot more information on different governments' uses of these different techniques. Another approach is for the parties to agree, ideally at the time the concession agreement is signed, on detailed methodologies for evaluation through an advanced pricing agreement, which is basically an advanced ruling on transfer pricing matters. I believe one was concluded over the last few years in Liberia. There's been some mention in the press of that, but for iron ore, I believe, but there are no details publicly available. And by and large, this is where the action is, the appraisal process. This is where money is. Governments lose a lot of money on the removal of their people's natural resources. And I think that for a country that with a substantial oil and gas or hard minerals industry, it's essential to place significant resources into the hands of tax inspectors so that they can do the type of detailed and authoritative analysis that's necessary. Next slide, please. Oh, well, we'll have time for that discussion. A closing admonition. To some extent, contradicting what I just said, as mentioned earlier, although product valuation issues are very important in the extractive sector, they are not the only important transfer pricing issues that arise in the sector. In addition, ordinary but important issues, often involving the use of hub companies, can arise with respect to the following issues and more: the intragroup provision of management and engineering services, intergroup sales and leases of equipment, very important in the mining industry and the drilling industry, transportation costs paid to related party shippers for the use of, say, tankers and ore carriers. A lot of companies have their own fleets, and you have to be careful about not overpaying, over adjusting for the cost of that transportation. Related party loans, extremely important in the natural resources area, which is very capital intensive. And there's tax administration with respect to related party loans is probably close to the importance of tax administration with respect to product pricing in the natural resources area. It's a very important area that needs to be, that the tax administration needs to be adept at dealing with, and that national statutes need to be cognizant of. Related party financial guarantees and related party hedging agreements. They're all very important. All these are very important in the natural resources area, so that when you have your product pricing under control, you're just getting started. Tax administration needs to generate a lot of internal expertise in order properly to deal with natural resource multinationals.
Yeah, I'm just gonna, we're gonna open it up for discussion on this. We have about half an hour of extra time, so I thought maybe we'd spend some time on the two pillars. But I will say on related party financing, it's a huge issue. And it's reoccurrent, not just in this industry, but more broadly in all industries, where you have in the diagram that Michael put forth, a hub company and an operating company, and some kind of financing arrangement between the two. And the taxpayers argue that if you look at the operating company on an arm's length basis, the price on the loan would be X, the interest rate in the loan. And then the government comes in and says, well, there's an implied guarantee by the parent company of the whole thing, the parent company over the hub company. And so the price really shouldn't be X between two independent companies. It should take into account the implied guarantee. And you can get into huge disputes over it. There have been a number of very, very significant cases involving that, one recently in Australia. But, it's sort of illustrative of the problems in transfer pricing. You begin to say, well, loans between two different companies, you ought to be able to do that fairly simply. What's the creditworthiness of the borrower? And then you can look at third-party rates that are all over the place and make a determination. But when you get into it in practice, the reality is it's quite complicated to do. Let me open it up. Michael, that was great. I thought we'd start out with some questions on transfer pricing. And then, since we do have a few minutes, talk a little bit about the pillars. I don't have a place for it elsewhere in the agenda, to be honest, so it's probably useful to do it right here. But let's stick with transfer pricing for a moment, and people have comments, questions, or suggestions they want to make. Go ahead and let us know. Speak up.
There's a question in the chat from Renmore.
Right.
Michael, from your experience, how has tax incentives promoted transfer pricing? Aggressive tax planning, to be specific? Well, tax incentives create an incentive to move income to the place that's providing the incentive. Generally speaking, there's a huge incentive to begin with to shift income to these hub jurisdictions, these hub companies. And I don't think that the tax incentives offered by operating countries by and large, have resulted in too much income shifting because there's so much income shifting going on in another setting. But the question with tax incentives, not only in the extractive industry, but in all industries really, is whether the tax incentive, whether the costs and benefits of the tax incentives are balanced from the standpoint of the country. I mean, tax incentives reduce your tax revenue. They also will tend to increase inbound investment. At least that's the argument. And I personally believe it is true to a large extent. So the question is, how, what's a balanced policy with respect to tax incentives? And it's complicated by the phenomenon that we've all discussed about of tax competition. Even if you don't want to give a tax incentive based on your own determination of what's balanced cost and benefit, your neighbor country may provide a tax incentive anyway. So there's the so-called race to the bottom, and that of tax competition, and that is almost certainly a very damaging kind of, in my view, phenomenon. And I think it's one of the things that Pillar 2 particularly is trying to address. It's an anti-tax competition.
Yeah, let me just add a comment. Frequently there are tax incentives in a contract. There may be a zero tax rate for a period of time. But I think even though there's a tax incentive, and so you'd say zero tax, no transfer pricing problem, the reality is that transfer pricing also sets the royalty rate. So there can be a transfer pricing problem within the production country, even though there's an incentive in some kind of a production agreement. Let's see, there's another question. Well, we have several questions here.
Sorry, can I come in?
Yeah, sure.
Yeah, maybe as you look for other questions, maybe just a follow-up question. I clearly heard you, Michael, when you said tax incentives may not to a large extent promote maybe transfer pricing or aggressive tax planning. And you also mentioned the issue of cost and benefit analysis. But you see, Michael, the challenge is there is no public available information for, let's say, for example, maybe the civil society or the academics to then do the cost and benefit analysis. Remember, for you to do the cost and benefit analysis, you need to measure the benefit. You need to also measure the cost. So there are, of course, there are proposed method of doing it. The one that is proposed by, I think, IMF, they sort of gave up a strategy or a way of doing it. But as I was analyzing it, I realized that there are a lot of missing gaps in terms of information for you to then do the cost and benefit analysis. That's one comment that I have. Then the question now is a follow-up question. So do you think the pillar 2, which is trying to charge an effective minimum tax rate of 15%, will address this issue of the rest to the bottom? And won't it introduce a new problem where we will be now rest the bottom of 15% now, where other countries will try by all means just to beat that 15%, so that you'll find that maybe in Africa, effective corporate tax rate will be reduced to a figure around 15% as a new way of like tax competition. Then the third question is concerning that pillar 2. Do you think it will bring meaningful revenues to developing countries? Is it something that we can bank on? Thank you very much.
I want to let John field that one, but first there's one remaining question on extractives that in the chat. Maybe I could address it briefly. The question is, kindly elaborate on abusive transfer pricing and what are its implications the extractive sector, for the extractive sector. And, that's interesting. That's a very interesting question that's asked a lot. And, on the one hand, I think that without any intention of taxpayer abuse, there can be disagreements between taxpayers and governments over transfer pricing. I think that's built into the uncertainty of the pricing, and it's built into the principle that people can, put their best arguments forward in the course of a controversy with the government. There does come a time when the positions taken might be so extreme as to be called abusive. My own experience is that happens. I mean, again, this is a self-serving observation because I've spent, although I don't practice in the private sector anymore, I certainly spent a lot of time doing so. I like to think that the most substantial taxpayers, substantial companies that are advised by reputable advisors do not get involved in the abuse of transfer pricing. I don't think it's a question of abuse. I think it's a question of the shortcomings of the field. That being said, I'm sure there are abusive situations, and there are probably even situations where people go beyond abusive transfer pricing to falsify, export records and things along those lines. So yeah, I'm sure it exists. I think though that there's, even before one reaches the problem of abusive transfer pricing, there's a problem of difficult functioning of the legitimate transfer pricing areas.
Yeah, before we get into pillar 2, and we'll spend a few minutes on it. Any other questions on the transfer pricing stuff we've been talking about? I will say tomorrow we're going to talk about corporate tax, and part of that's going to be a discussion about financial accounting. If you want to get a sense of, I hate to use the term abusive, but aggressive tax planning, one place to start is looking at the effective tax rate of multinational enterprises. And frankly, the extractive industry is probably not the ones that are most most engaged in that. If you look at some of the digital businesses based in the United States that have effective tax rates in their foreign income of below 10%, some close to 0, you get a real sense of people that are being aggressive and probably overly aggressive. But we'll get into that a little bit tomorrow. Let's see, we have a couple questions in the chat box. One has to do with minimum tax, which we'll come back to. Joy had a question here, which I don't know, Michael, I need to put my glasses on to read.
Same here.
Let's see, is it possible for countries to have an optimal transfer pricing system so that the income they make tax collection matches expenses they incur in collection tax? Well, hopefully they get more income than the expense they incur, but go ahead, Michael.
Yeah. There's a lot of discussion of the optimal tax enforcement in the economics literature. And the idea is that you shouldn't have enforcement to the point where each dollar of enforcement expense brings in a dollar of additional revenue. So you don't want to be that optimal because having that effective tax enforcement system in the country would probably be overly intrusive and stifle economic activity. So you do, but and so most governments that have active corporate tax enforcement regimes try to get, they try to reach a ratio. I don't know exactly what the IRS does, I forget, but it was something like $1 to $15 or something along those lines. I don't remember what the number was, but it is theoretically possible in academic journals that very few of us will want to read to come up with an optimal transfer pricing system. As a practical matter, I think it relies on the judgment of the political process. You might get assistance from some of the economists. I mean, in my experience, have been excellent at IMF or World Bank to address a problem like that. They would. I'm sure that the Fiscal Affairs Division of the IMF would be happy to provide assistance on trying to think through this question of optimal enforcement in a disciplined way. But I think that most they'll do is basically make your judgment better a little bit. There's no magic answer, unfortunately, to the problem. It's a very good question, though.
Any other questions on or comments that people would like to make on transfer pricing? We will spend a few minutes on Pillar 1, Pillar 2. I don't see anything. Well, let me kick off the discussion, Pillar 1, Pillar 2 with
sorry, can I come in? Sorry. I didn't hear the answer regarding the cost and benefit analysis of tax incentives, where I was saying how best can we assess those cost and benefits from the tax incentives in the mining sector, of course.
Yeah, it's very complicated, and one of the factors you need to take into account is whether enforcement could actually become excessive and become a disincentive to investment. On the other hand, there's a large amount of revenue involved for the country, and you don't want to give that up. I'm not aware of anything other than kind of carefully reasoned judgment that can help you get to an optimal point. I mean, there are economists who are very good at dealing with questions like this. I've had some association with the Fiscal Affairs Division at the International Monetary Fund, the IMF, and I'm quite sure they would be willing to consult with a government that was trying to address this question and just share the experience and analytical methods that they use. That's the kind of thing they think about a lot. And I guess my only response is that to try to make these determinations carefully and with the assistance of economists who have, from a reputable source like the IMF, who have worked on this question. It's a very important question, and I think it's very hard to address without the benefit of a good deal of experience in that kind of question.
Anything else on that, one more?
Thank you. That would be great. I will be looking forward. Maybe I will chat with him later. Thank you.
Okay. Well, let me spend a minute on Pillar 1, Pillar 2, then we can open it up to a conversation. We could spend probably days discussing the two pillars. Let me start with Pillar 1 to begin with. The extractive industries are carved out of Pillar 1. So in one sense, there's no need to talk about it. I will say that in terms of transfer pricing, as we've already indicated, the interesting thing about Pillar 1 is that there is an incorporation of formulary apportionment into the pillar. So that's interesting. The other thing that I think is interesting is that this whole question and nexus, the right of source countries to impose a tax, Pillar 1 essentially adopts a substantial economic presence standard, and one can certainly advocate for that in a digital age. Let me turn to Pillar 2, but I think it has more impact, and the questions in the chat box seem to indicate that. And Pillar 2 is, as I think we've already discussed, imposes a 15% minimum tax on countries. I think the important thing in terms of looking at developing countries is that the way it is imposed, there's sort of three pieces to it. One piece is that the parent company or parent jurisdiction, the resident jurisdiction of the multinational enterprise can impose an income inclusion rule, which imposes a minimum tax across all of its companies, irrespective of whether the source country, the developing country, wants to have one imposed or not. And then there's a second piece that's somewhat similar to that, which is the, I guess to call it by a new name, undertax profits rule, which essentially accomplishes the same thing, even though the parent jurisdiction does not want to do it. It permits other jurisdictions to do the same thing with something of the same effect as the income inclusion rule. And then finally, there's a rule that permits the source countries to impose their own domestic form of minimum tax that would comply with the Pillar 2 standards. So those are the three elements. I think the critical question for developing countries, particularly in this area of extractive industries, where in many cases the investment agreements that are entered into have a tax holiday for a period of years, like 10 years or even longer in some cases. And in many cases, even after the tax holiday, they then have a reduced rate of tax. You have that situation, and along comes these minimum taxes that essentially would override the benefit of the tax incentives that have been granted by the developing source country. And so what is then the place or the position of the developing country? This is revenue that they will not see unless they react to it. On the other hand, they gave the incentive. And so it poses quite a predicament for the developing countries as to what they should do. In some cases, they are contractually bound by the agreement they entered into. There may, in fact, be arbitration provisions, stabilization clauses that make it very difficult to overcome that agreement. And so it poses a real dilemma with a particular impact in this area. That's kind of my opening comment on this. Michael, would you care to comment? And we'll open it up for some discussion if people would like to talk about it.
Yeah, my overall feeling on this is that that Pillar 2 would be effective in lessening, not eliminating by any means, but lessening tax competition. I think that tax competition has over the decades been induced countries to offer far more tax benefits, both explicitly and implicitly, than they would in the absence of tax competition. And I personally think, and I know it does sound cynical, but I guess I've got to accept it, my age, that I'm going to be cynical for the rest of my life. I think that a lot of the reason that countries around the world, developed and developing countries, have tolerated tax-based base erosion and profit shifting, largely through the use of hub companies, is because they're afraid to cut back on their own. They're afraid to control that tax avoidance for fear of losing business to other countries that do not cut back. So I think that the idea of all the countries of the world in concert limiting tax competition is a good idea. I think that there's a balance between taxation and investment, and I think that because of the tax competition, the world as a whole has undertaxed an overly incentivized investment. Not that I think investment's bad, but I think that eliminating tax competition would bring us into, or reducing tax competition would bring us into a more closer to optimal balance. So I think that Pillar 2 is a relatively straightforward way of doing it. I think it was well thought out. I hope that a version of it ends up in the world tax system.
Yeah, I will say the other innovation in Pillar 1 and in Pillar 2 is the use of financial statement accounts to calculate income. And I think the use of financial statement accounts works well where the taxpayer is a public company or a large enough company to have significant credit involvement and where their pre-tax income is important for other purposes. Where you get into smaller companies where they don't have that significant pressure, sometimes I think using financial accounting income just will lead to a loss of revenue because people will fiddle with their financial accounts. Let's open it up to discussion. There seemed to be a fair amount of interest in at least Pillar 2 and the minimum tax. Would people have comments they'd like to share, questions? I know there were some in the chat box, so let me pause and see. Don't be shy, folks. It's almost time to go, I know.
Hi, good morning.
Hi.
Yes, I had put a comment in the chat, but
Sure.
this has to do with the fact that small developing countries have very limited resources, and therefore foregoing taxes becomes a viable option for them. In other countries, all kinds of non-tax incentives are provided. In the United States, for example, in Europe, Canada, all kinds, for business, all kinds of non-tax incentives are provided. Grants are provided, access to facilities, education, and all of these things have a monetary value. So you find that the government is quite often providing these. Then you have companies in the private sector that are able to do it because they will get some kind of deduction or allowance on their corporation tax returns, or there are all kinds of foundations set up that get tax benefits. The small developing countries don't have that option. So then you move into a tax framework where we pretend that none of these other things are happening. And, you know, the conclusion is that if you're able to have a minimum rate of tax, that it would solve problems and that no country would be disadvantaged because the tax would be the same. But it ignores the fact that small states simply do not have the resources of larger or more developed states. All of these taxes, for example, everything that's done in the tax forum in the OECD, for example, ignores everything else that is happening in other places, such as the World Trade Organization, which, for example, small countries will be a member, but we're not members of this organization, the OECD, which is the advocate for these tax developments. So in my view, yes, it might help us with tax competition, narrowly defined, but not broad economic competition, which that isn't a pariah, but tax competition is. So that's the way that I see it. in a small developing country, we don't have the resources to do the things that within developed and larger countries are able to do. So in that sense, to me, it isn't quite fair because it doesn't look at the big picture. You're just zooming in on taxes here and nothing else.
Yeah, no, I think that's an excellent point. I think to take that and make it into a broader conclusion, you know, when you start imposing minimum taxes, particularly without the consent of the developing country or the source country, you are in fact taking away an element of sovereignty from that country and its ability to do what it thinks is best. And, you know, that's a problem. And you can come out on either side of that. So but I think your point's an excellent point. John, John O'Cara, did you want to make a statement? Okay. Marty, oh, there's a hand raised here.
Learn more. Yes.
Okay.
Learn more. Okay, Lamar, sure.
Okay, thank you very much. I just want to make my comments regarding Pillar 1 and Pillar 2. Yeah, I think Pillar 1, like exactly you said that it has minimum effects in terms of addressing, I mean, issue of tax competition. Of course, then Pillar 2, have got, I mean, more to do with the reducing tax competition, like the previous speaker said, that yeah, in terms of tax competition, it narrowly, but for us, what matters most is like, what is that are we going to come out with in terms of revenue from that 15%? So the challenge now, when I look at the African continent, we are not that united to the extent that out of the 54 countries, some are already a member to the inclusive framework and some are not. And also from the perspective that we already have the digital sales tax, in other words, the unilateral taxes, we are sort of like enjoying, for example, Zimbabwe is charging unilateral taxes regarding the digital economy, where we charge like 55% of the sales of a company, which is sells something like 500,000 US dollars on internet, being it Facebook, Alibaba, and so forth. I don't want to get much into that, but my point is, we have what revenue is at stake. The revenue that you are receiving in form of unilateral taxes. And through this Pillar 2 or Pillar 1, we are being told to lose what we have in the end for possible revenue that may come through this proposal. So now, where my challenge is, what will happen now to those to those African countries who are not member of the inclusive framework? Say this deal sails through, where the inclusive framework is agreed. I foresee the African continent who are not members of the inclusive framework losing some income, since the tax that is not collected in Africa will be collected somewhere else. I'm talking about these two methods, the the income inclusion rule, and the other one is underrated payments rule. So either way, if you look at it, we are on the losing side. Yes, we will benefit narrowly in terms of those countries that were taxing effective rates, CIT, which is less than 15%. But for those who are charging above, there's nothing much to benefit. So these are my comments regarding the Pillar 1 and Pillar 2, and especially under the extractive sector. Thank you very much.
Sure. Well, I think those are good comments, Lamar.
May I just ask a question, please?
Sure, sure.
Yeah, in terms of Pillar 1, how would you see that working for a small country with a population of about 300,000 people.
Yeah.
So I'm asking you to assume what percentage of the turnover of a multinational corporation we would be able to consume. You know, like, will we reach a threshold to tax anybody, do you think?
Yeah, Pillar 1 has, for its application, has a two-tiered system. So the tier 1, for want of a better term, is for mainly larger developed countries. Tier 2 goes down, and it has a different measure of when a company is subject to tax there. I will say that very small, so the measurements are based on GDP for the country. And if you're below a certain level, then you have a lower measure for a taxable presence. In other words, for Pillar 1 to apply, there has to be a certain amount of sales attributed to that company or country. And if you don't reach that threshold, then you're not entitled to a share to Pillar 1 revenue. And I'm trying to remember from memory exactly what the threshold is, but I think it's for smaller countries, and Michael, you may recall better than I think it's $250 million dollars of gross revenue. So if you don't meet that threshold, then you're really not included in Pillar 1. For a very small country, I think it's fair to say you're not going to get anything out of Pillar 1.
No, you see, part of the difficulty with it is that even though we will get nothing, there will still be an insistence, and because we're small, we can be pressured. There will still be this insistence that we put all kinds of legislation in place, which actually costs us money, and that we be able to administer it for the benefit of revenue authorities in developed country jurisdictions, that we should be able to respond to requests from them. That costs us time and money. So we get no benefit, and there is no recusal from the obligations. That's the difficulty. Arguably, we should just be excluded and be required to do nothing if we do not benefit.
Okay, that's a fair comment. I'm not sure. Certainly there are obligations imposed on countries. I'm not sure that Pillar 1 would impose a separate one, but arguably it could. I don't know, Michael, did you have a comment on that?
Well, just a reminder that Pillar 1, in addition to the large structure of formulary apportionment and amount A, which is very complicated, also has an amount B, which is a very simplified, it offers a simplified transfer pricing method for marketing companies inside a country's jurisdiction. Like, it would basically provide for a minimum amount of income to be attributed to the Kenyan automobile dealer in the example I used in the text. It was very much simplify transfer pricing methods, which are now ridiculously complicated for distributors and for marketing companies. And even though there's the whole Pillar 2 structure is in danger of not being adopted politically, I hope that amount B in Pillar 1 will be will make it into the country's laws. And any of you who are involved in the inclusive framework discussions, please fight hard for amount B, Pillar 1.
I think that's a very useful comment. Okay, Lamore, I think we covered you. Did you have an additional comment? I see your hands up, but I think that probably relates to an earlier comment. you wanted to make.
Yes,
Okay.
I have a comment to Lynette, like what she was saying in terms of being a small country. You know, one day I was just analyzing, looking at the countries, the African countries that have joined the inclusive framework. Look at their sizes. I think the major question is, do you have multinational companies in your country? That's number one. Then number two, do you have a meaningful market for those goods that we may be sort of like talking, being it Google, being it whatever the digital economy that we will be talking about. So I think it's just a matter of like those issues. But I agree with you. Some of our leaders are just joining this inclusive. Maybe they are afraid of maybe the what can I say? The firing back for not being part of the group, because there are other issues that we need from these developing countries, maybe being loans, and so they're afraid it may be one of the conditions that, okay, you look, guys, you are not supporting us in terms of the inclusive framework, but you still need the help from us. So it's just like political pressure, or I would say peer pressure. But honestly, there's nothing much to benefit. I'm not sure about the amount B that Michael was talking about, because it also depends on, do you have multinational companies in your country? Thank you very much.
Okay, good comment. Jason, did you want to make a comment? No, okay. I don't see, we're really at the end of our time. I think we had a good discussion today. Thank you, Michael, for a wonderful discussion on transfer pricing. Tomorrow, we're going to take up corporate taxation. We have, I'm going to talk a little bit about financial accounting. We will look at Rio Tinto to see an example of some of the issues about financial accounting. And then we have an outside speaker from Weber Wenzel that will talk in more detail about the taxation issues that arise in corporate tax. So thanks again.